Let's ask those questions to Maneesh Dangi, CEO and founder of Mosaic Asset Management. Manish, good having you. Thanks for joining in. Just trying to understand from where you are perched and when you're looking at the landscape, are there growth pangs? Is this a cyclical downturn that we are entering in, and could it last for longer?
Longer questions actually basis, how long do you expect? Typically, cyclical slowdowns tend to last for about 12 to 17, 18 months. But the first question, of course, is there is certainly no case of structural slowdown in India. There is little doubt now that India is slowing down pretty rapidly in the last couple of months. So it appears to be a cyclical slowdown. All signals, both in consumption as well as industrial slowdown, is underway right now. We saw that happen in Europe in 2022. Part of it was structural. A lot of it was cyclical. China, it happened in the last 17, 18 months. India seems to be the next big economy entering a cyclical slowdown.
Maneesh, just a follow-up on Neeraj's question. What and how did this cyclical slowdown suddenly happen? And do you feel like a monetary policy action could help it? I ask you this because that's all we've really talked about in the last few months. But everything looked well till a quarter ago, I thought.
Economies tend to have these 18, 20 months of boom-bust cycles, industrial economies at least. Why do they happen? It's the way nature of things are, that, things go up, come down, go up, come down. So the only truth in economies and markets is that, they are cyclical. Antidote or a solution to that is, of course, policy easing, because cyclical slowdown would not last for very long if an appropriate policy response come in, either by way of fiscal stimulus or monetary policy cuts or regulatory easing. So all of these are, necessary conditions for us to tame or to ensure that the cyclical slowdown is not too deep. Now, would that happen or not? Of course, we should discuss. There are right now problems of signaling as far as RBI is concerned. On one hand, RBI is trying to signal NBFCs to tame down. Because RBI seems to be worried of household leverage here and excessive growth in NBFCs. So simultaneously, you really can't ease rates. So which is why they have to sequence it. They have to ensure that the NBFCs and many personal loan segments slow down, and only then they'll be able to unleash monetary policy easing.
Manish, the telling part of all commentary that we've heard thus far from the corporate sector on the consumption side is that rural may be picking up a little bit, but urban is definitely slowing down. Now, is this a base effect? Because post-COVID, everybody said, oh, let's spend on experiences, etc., so on and so forth. So people have spent for 3 years on a trot. Is there satiety plus base effect coming into play here? And will this change if indeed the growth doesn't falter too badly?
Yes, you're right that all economies have gone through this small bust is essentially because COVID response, revenge shopping of sorts, did happen for a while. India actually sustained it longer than, many other large economies outside of US, of course, which continues to roll, which basically means that, Indian conditions were relatively better. But then as it has happened in all other parts of the world, we are also slowing very rapidly. So basically, yes, it's a post-COVID surge and a slowdown. But had COVID not been there, something else would have been there. They would have been slowed down first in 1920 and then rise and rise. So in a sense, it has happened, right? In this every 3-4 years, you have these small cycles slow down. This time, unlike the previous slowdowns, macro seems recent. You have low inflation, current account deficit is low. There's a space in terms of monetary policy. So, we can deal with it. It's just that it's a sequencing problem RBI is grappling with, and which is why, even though India requires, paradoxically, more rate cuts than US, and yet we don't get it because RBI is trying to signal to the NBFCs and the financial sector to slow down first. And so therefore they don't want to confuse markets right now, which is why we're sort of having a little bit of a delay in policy response. The collateral damage of that, of course, is that the slowdown can persist for longer and get little deeper before it gets better.
And then that argument about too little, too late will begin, but we'll wait till that happens. I want to talk about bottom line in that sense, right? Raw material prices have been a big concern for consumption names. Actually, anything that's consumer facing has had a struggle. Commodity prices are on an uptick. Imported inflation hence becomes a problem for India. Even local inflation now is a problem with what we've seen in terms of agricultural output. How is this inflation piece going to fit in the puzzle? Because if you have slowdown on one hand and inflation on the other, it's a much tighter row for the RBI to walk than it is for a Federal Reserve.
No, I have a little bit of contra view here. I don't think inflation is a problem in India. Core inflation for whole of 2024 has been near to 3%. So demand is a problem in India. Inflation is not, and therefore purely from a growth inflation dynamic, the pace you can sort of have a reasonable amount of monetary easing. So again, I don't think that we'll have too little of monetary easing. I think, and I've argued this in the past, that India in this cycle will end up having pretty substantial easing to the extent that bonds would go to the levels that we haven't seen for the last many years. At 5 handle or so. So again, India is sort of witnessing growth slowdown. Both urban, actually more deeply, rural has been a listless part of economy in any case, and did not grow as much as we would have anticipated, even though the food production has been decent. So it's an urban consumption slowing which is driving the Indian economy down. Core inflation is pretty low, and therefore the space for monetary easing, purely from the point of view of growth inflation mix, is pretty substantial right now.
I'm going to make a quick comparison to what's happening in China, only because we've been talking about it so much. So I think we should end the week also talking about it. How has global economic uncertainty, particularly the slowdown in China, in your opinion, impacted investment flows or trade inflows into India? And I'm not going to talk about the money that comes in, or non-sticky money that comes into equity markets, but more from a structural angle.
So the FDI flows in India, for the last couple of years have been listless, frankly. Barring the first year of COVID, since then I've made this argument on your channel also many times that FDI is surprisingly a missing piece. So there again, no incremental surprises. It's simply FDI, FII are very sluggish in India over the last couple of years. What is surprising, actually, I'll tell you, is that after all the halla of that capex recovery is underway, what we now know as a matter of fact that it has not happened, despite very high capacity utilization, very high margins in corporate India. Outside of the top 500 corporate, the capex in a reasonable manner that should have happened by now hasn't kick-started yet. Which is sort of so the story in India right now is not that the consumption is slowing down. That is something that we could have expected that would happen, as it happened in many other parts of the world. What is surprising is that the industrial capex in India has not accelerated, despite all the enabling conditions being in place for the last couple of years, which is the only sort of thing that equity markets or even policymakers should be worried of as to why did it not happen. The proximity to China is only to the extent that China is glutted with sort of manufacturing good. And so to some extent, it is a deflationary force for the entire world, also of India. And also whoever is, let's say, is competing with China will have this dampening force coming from China and, potentially would not crank up more capacities, So that is a China connection that India has. Which is the negative one. Positive one, of course, is that we actually import large amount of goods from China, and if they get cheaper, it's good for us.
You're such an expert on the economy, just like you're in equities. We'd love to. I mean, I personally would love to chat with you longer on the macros, but hopefully we'll do that the next time we catch up.